let's get in, a short conversation, but a conversation nevertheless with Ajay Srivastava, because it's always good having him. Ajay, thank you so much for taking the time out and being with us.
Good morning, Raj. It's been wonderful to have you. Be there on this place. Wonderful to be with you.
Thank you so much. Well, Ajay, not so wonderful in terms of news flow. It's finally out that we have those 50% tariffs. I heard the people that we spoke to since morning all said that this might be short-lived, etc. But until it goes away, do you think there is a cloud, or is the market baking in the worst already?
I think market is baking in the worst because I think if you look at the listed universe, Nikunj, that listed universe is not so much directly impacted compared to the vast majority of SMEs, unlisted companies, which are underpinnings of the Indian economy. So directly speaking, a lot of the listed companies, whether it's auto component company, auto export companies, or pharma companies, are today sitting out of it by and large or with minor impact. And therefore, the listed universe doesn't have a direct P&L impact of such of the tariffs. I think it's a vast segment which is unlisted sitting there, which is ultimately going to translate into lower consumption story and the lowest GDP story. But that will unfold over a period of time. You know, the optimism of GST cut perhaps will get tempered, just as the way we saw the huge euphoria on interest rate, which was mistimed, has been totally lost in the next 2 months with interest rate higher than they are. So I think this is going to impact the consumer euphoria story much more than I think the listed universe story, because they are by and large insulated. They address the Indian market. A cement company doesn't care a damn about the tariff, for instance. Steel company is very happy with the protection. Paper companies are happier with more protections coming from them. So Indian industrialists, listed space by and large, are in a very happy space, and they will in fact, with using the tariff as an objective, get more and more tariff protection for themselves and their companies. So I would tend to believe that listed universe, much less impact. I think consumer space will see the impact in the next 2 months as the consumption drops, the unsecured loans start to soar up, and so on and so forth. That's the story which is important today, not necessarily what's the impact on the listed companies, which is, I think, quite little.
Okay, but so Ajay, would you therefore believe that, okay, one view that came in the morning, Ajay, was that if indeed tariffs stay, then earnings cuts could continue. You don't believe earnings cuts could be the reason that the markets may go down because of tariffs? It may be sentimental, it may be GDP slowdown, it may be employment problems, but not earnings cuts.
No, I think earning cut is a logical extension of a fall in GDP at the end of the day, Nikunj, because that's what is happening.
Neeraj, you're missing Nikunj too much, but this is Neeraj.
Neeraj, sorry, I'm missing Nikunj. See, it's like this, that the GDP cut is going to impact everybody across the board, whether you want to buy a house, whether you're going to buy consumer products, and anything at all at the end of the day. Therefore, you will see an earning cut is already happening. Our problem is different. Our market is overvalued. You know, we got stocks of P's of 90 and hundreds. Companies are flat year on year, and the P is 100, 110. It's absolutely ridiculous state of valuation in this country, and at what valuation mutual funds are buying. Absolutely insane. Nobody logical would buy these shares at these valuations, and therefore we are sitting on a pile of FI exit, because no one rational can understand why are you buying a share which is flat year on year on profits, but quoting at a P of 100. It's insane, absolutely. So I think we have more a problem of valuation, which is absolutely nonsensical in most cases today. Certainly every P's of 75 and above are absolutely nonsensical, and compared to just the issue of earnings. So, you know, it doesn't matter how much you earn. You're not going to justify 75 P in a scenario like this or any scenario. So it's quite simple arithmetic. You get out and invest in countries where the P's are 10, 12, 20, 25, and the earnings are 15, 20% growth, as simple as logic. So issue is not about earning, issue is about valuation, which are just disproportionate to what we are making in this country.
Ajay, at this juncture, you're talking about valuations, we're talking about tariffs, you're seeing the way GDP will translate into an earnings degrowth as well. What would you advise an investor to do? Buy right now? And secondly, if buy, what sectors?
See, they're always good stories. In any market, they're very good stories which are running around. Today, for instance, I would certainly believe that the gold loan story has got a tremendous way forward, because for the simple reason, as this problem unfolds, and hopefully it does not continue, but even if it continues for long, the first recourse of most entrepreneurs, workers, etc., who get impacted is going to be the gold loan. I think that's one story which has done well in the last 1 year, should do well in the next 2 years. I think that's a brilliant story built out there, and that should do well. Segments like hospitals, they just do well at all points of time in the economy. The worse the economy get, the more people head to the hospital at the end of the day. So I think you have got domestic segments which are reasonable stories, little expensive perhaps, but still a reasonable growth stories to work with. I think the stories which are problem areas are consumer, which have got tremendously re-rated at this point of time, and retailing stories which are just outrageously expensive to buy into. And on auto is again a story which is long-term good story for India, because as your past guest told you, you can't replace an auto supplier overnight. You can do it in good time, but you can't replace him overnight. So at the end of the day, between autos, gold loan, and you're seeing the story coming out in terms of hospitals, I think you have reasonably good stories. And of course, some of the new age economy stocks are doing reasonably well at this point of time. You have got a reasonable portfolio. India is having so many IPOs, good stories coming out. So it's not that we have got dearth of stories. It's just that fact you need to buy at the right price to make a return for yourself. 20% return is what you should be targeting, and that's difficult in the market. So be very selective, I would say. No hurry to buy. You'll get your chances. You've seen your chances. You already got again. You got in September. You're getting again in the month of August, September, as we get into September. So year to year, you are getting chances to buy. Now, if you had bought on a high, then you are, my friend, you are in trouble. But if you kept your powder dry and go and buy in markets like this, with the stocks that you like, I think you'll be in. So I think contrary to what most people say, keep buying. There is no timing issue. I'm a firm believer. You need to wait a while to get your entry right. If your entry is not right, stock cannot give you the return, no matter how good it is.
Wise words of wisdom. Unfortunately, out of time completely today. But this truncated conversation means, Ajay, that we have to do one up very, very soon.
And I apologize for confusing you.
No,
sorry.
not at all.
You're still my favorite. You're still my favorite.
By the way, that I know. But thank you so much for joining in today, Ajay. Thank you so much.